October 22, 1907. J.P. Morgan, the most powerful banker in America, locks the doors of his library on Madison Avenue. Inside are the presidents of every major bank in New York. Outside, the American financial system is collapsing. Banks are failing. The stock market has crashed. People are rioting to withdraw their money. The United States is hours away from complete economic collapse. Morgan won't let anyone leave until they agree to save the system. Here's the crazy part. There was no Federal Reserve in 1907. No central bank. No lender of last resort. No government agency to stabilize markets or guarantee deposits. When the financial system started collapsing, there was nobody to call except J.P. Morgan. One man, one private citizen, standing between America and economic catastrophe. And he almost didn't do it. Morgan was 70 years old, tired, and had been considering retirement. He'd made his fortune. He'd built his empire. He didn't need to risk everything to save a system that was failing because of other people's greed and stupidity. But when the crisis hit, everyone turned to him because there was literally nobody else. The panic of 1907 wasn't just a financial crisis. It was the moment America realized that having one private banker as the de facto central bank was insane. It was the crisis that led directly to the creation of the Federal Reserve 6 years later. It proved that modern economies need central banks, need lenders of last resort, need someone with the authority and resources to stop panics before they destroy everything. But in 1907, that someone was J.P. Morgan. And the fact that he succeeded, that he actually did stop the panic through sheer force of will and personal capital, makes the story even more remarkable. Because it shouldn't have been possible. One man shouldn't be able to save an entire economy. The fact that Morgan did it proves both how powerful he was and how fragile the system was. This isn't a story about greedy bankers or reckless speculation, though there was plenty of both. This is a story about what happens when a financial system has no safety net, no backstop, no plan B. And it's a reminder that the institutions we take for granted today, like the Federal Reserve, exist because people learned hard lessons from disasters like 1907. J.P. Morgan was 70 years old in 1907 and arguably the most powerful private citizen in America. He wasn't just a banker. He was a financial titan who had reorganized entire industries. He'd created U.S. Steel, the first billion-dollar corporation. He'd saved the U.S. Treasury during a gold crisis in 1895 by organizing a private bailout. When Morgan spoke, markets listened. When Morgan acted, things happened. But by 1907, Morgan was tired. He'd been battling health problems. He'd been spending more time on his art collection and less time on banking. His firm, J.P. Morgan & Company, was still the most powerful bank in America, but Morgan himself was thinking about stepping back. The crisis would force him into one final fight. Charles Barney was president of the Knickerbocker Trust Company, one of New York's largest financial institutions. Trust companies in 1907 were shadow banks, doing many of the things regular banks did but with less regulation and lower reserve requirements. They were profitable and popular. Barney had built Knickerbocker into a powerhouse. But he'd also gotten involved with some questionable speculation schemes. When those schemes collapsed, they'd take Barney and Knickerbocker down with them. Augustus Hines and Charles Morse were the speculators whose schemes triggered the panic. They'd been trying to corner the market in copper stocks, borrowing heavily to buy up shares and squeeze short sellers. When the corner failed, they couldn't repay their loans. The banks that had lent to them started failing. Hines and Morse weren't evil geniuses. They were gamblers who bet too big and lost. George Perkins was a partner at J.P. Morgan & Company and Morgan's right-hand man during the crisis. While Morgan was the face of the rescue efforts, Perkins was doing much of the actual work, coordinating between banks, organizing the bailouts, and keeping track of who owed what to whom. Benjamin Strong was a young banker at Bankers Trust who worked closely with Morgan during the crisis. Strong's performance during the panic impressed Morgan so much that he'd later become the first governor of the Federal Reserve Bank of New York when the Fed was created. The 1907 crisis launched Strong's career and shaped his thinking about central banking. Theodore Roosevelt was President of the United States during the panic. He'd built his reputation as a trustbuster, going after big corporations and powerful financiers. But when the crisis hit, Roosevelt had to swallow his pride and work with Morgan because the federal government had no tools to stop a financial panic. The Treasury had some gold reserves but no legal authority to act as a lender of last resort. To understand the panic of 1907, you need to understand how primitive and fragile the American financial system was at the time. There was no Federal Reserve. The United States had tried central banking twice before. The first Bank of the United States was chartered in 1791, but not renewed in 1811. The second Bank of the United States was chartered in 1816, but killed by Andrew Jackson in 1836. After that, America went without a central bank for almost 80 years. This created enormous problems. Banks couldn't coordinate during crises. There was no lender of last resort. When panic started, banks failed in cascades because there was nobody to stop the run. The system lurched from crisis to crisis. The Panic of 1873, the Panic of 1893, smaller panics in between. By the early 1900s, the system was more complex but no more stable. Trust companies had emerged as major financial institutions. They took deposits like banks but weren't subject to the same reserve requirements or oversight. They paid higher interest on deposits, making them popular with savers. But they also took bigger risks. The economy in 1907 was in a weird state. There'd been rapid growth and speculation for several years. The stock market was high. Real estate prices were elevated. Credit was easy. But there were warning signs. Interest rates were rising. Some banks were struggling. The British, worried about their own economy, were pulling gold out of New York. Then in October, the Copper Corner scheme collapsed. Augustus Hines and Charles Morse had been trying to corner the stock of United Copper Company. They'd borrowed heavily from banks they controlled, using the money to buy copper shares and squeeze short sellers. If the corner succeeded, short sellers would have to buy shares at inflated prices, making Hines and Morse rich. But the corner failed. There were more shares available than Hines expected. The price of United Copper collapsed instead of soaring. Hines and Morse couldn't repay their loans. The banks they controlled were suddenly insolvent. This wouldn't have been a systemic crisis except for one thing: trust. The failure of Hines's and Morse's banks made depositors nervous about other banks. And trust companies, with their lower reserves and higher risk profiles, were especially vulnerable. If depositors lost confidence and started withdrawing money, the trust companies would fail. That's exactly what happened. Rumors spread that Knickerbocker Trust had been involved with Hines and Morse. It wasn't true, but it didn't matter. Charles Barney, Knickerbocker's president, had some business connections to the failed copper scheme. That was enough. On October 21st, depositors started lining up outside Knickerbocker Trust to withdraw their money. This is a bank run. Even a healthy bank can't survive a run because banks don't keep all deposits in cash. They lend most of it out. If everyone demands their money simultaneously, the bank fails. Knickerbocker tried to meet the withdrawals. They paid out millions. But they were running out of cash. They needed help from other banks. They needed someone to lend them money to meet the withdrawals until confidence returned. They needed J.P. Morgan. Sunday, October 20th, 1907. Charles Barney goes to see J.P. Morgan at his home. Knickerbocker Trust is in trouble. Rumors are spreading that they're connected to the failed Copper Corner. Barney needs Morgan's public support, a statement that Knickerbocker is sound, to stop the panic before it starts. Morgan looks at Knickerbocker's books. He doesn't like what he sees. The trust company has been taking too many risks, lending to too many speculators. Morgan tells Barney he won't help. Knickerbocker is on its own. This is a death sentence. Without Morgan's backing, Knickerbocker will face a run and fail. Barney knows it. He leaves Morgan's house devastated. Within days, he'll commit suicide. Monday, October 21st. The run on Knickerbocker begins. Depositors line up outside the main office on Fifth Avenue. They wait for hours in the cold to withdraw their money. Knickerbocker pays out $2 million by noon. But the line keeps growing. By mid-afternoon, Knickerbocker runs out of cash and closes its doors. The Knickerbocker Trust Company, one of New York's largest financial institutions, has failed. The panic spreads immediately. If Knickerbocker could fail, any trust company could fail. Depositors start lining up at other trusts. Trust Company of America, the second largest trust in New York, faces massive withdrawals. By Tuesday morning, they're running out of cash. This is where the crisis becomes systemic. Trust Company of America is much bigger than Knickerbocker. If it fails, it will take other institutions down with it. The panic will spread to regular banks. The stock market will crash. The entire financial system could collapse. On Tuesday morning, the president of Trust Company of America goes to see J.P. Morgan. "We're going to fail unless someone helps us. We need cash to meet withdrawals." Morgan examines their books. Unlike Knickerbocker, Trust Company of America is fundamentally sound. They've been taking withdrawals, but they have good assets. They just need liquidity, cash to meet the immediate withdrawals until confidence returns. Morgan makes a decision. He'll organize a rescue. But he can't do it alone. He needs other banks to contribute. He needs the government to help. And he needs to move fast. Morgan calls a meeting at his office. The heads of New York's major banks gather. Morgan lays out the situation. Trust Company of America will fail today unless we act. If it fails, the panic spreads to all of us. We either hang together or we hang separately. He strong-arms the bankers into contributing to a rescue fund. Some do it willingly, recognizing the systemic risk. Others do it because Morgan gives them no choice. By Tuesday afternoon, Morgan has organized loans of $25 million to Trust Company of America. But the crisis is still escalating. The stock market is crashing. Stockbrokers need loans to settle trades, but banks won't lend because they're hoarding cash. If the brokers can't settle, the stock exchange will have to close. That's never happened before. Closing the exchange would signal total collapse. On Wednesday, Morgan gets a call. The stock exchange needs $25 million immediately, or they'll have to close in 15 minutes. Morgan turns to the assembled bankers in his office. "We need $25 million in 15 minutes. Who's in?" In 16 minutes, he raises $23.5 million. It's enough. The stock exchange stays open. But barely. Thursday and Friday see continued chaos. More institutions are failing. The mayor of New York needs to deposit city funds somewhere but doesn't know which banks are safe. He goes to Morgan. Morgan tells him which banks can handle the deposits. By the weekend, Morgan realizes the crisis is bigger than he thought. It's not just trust companies anymore. Regular banks are under pressure. Depositors are hoarding cash. Credit is freezing up. The whole system is seizing up. On Saturday night, October 26th, Morgan locks the doors of his library. Inside are the presidents of New York's major banks. Outside, the city is on the edge of chaos. Morgan tells them nobody leaves until they agree on a solution. They stay all night. Morgan sits in his study playing solitaire while the bankers argue in the next room. Periodically, he comes out to push them toward agreement. By dawn Sunday, they've hammered out a plan. The banks will pool resources, support each other's deposits, and present a united front. But there's still a massive problem. The city of New York needs to issue $30 million in bonds to meet its obligations. No bank will buy them in this environment. If the city can't sell the bonds, it will default. A municipal default in the middle of a financial panic would be catastrophic. Morgan takes the city bonds himself. He organizes a syndicate of banks to buy the bonds. It's risky. If things get worse, the bonds could become worthless. But it prevents the city from defaulting. By early November, the worst of the panic is over. Morgan has organized rescue after rescue, bailout after bailout. He's used his own money, his firm's money, and money he's strong-armed out of other banks. He's worked 18-hour days for 2 weeks straight. He's 70 years old and exhausted. But the system has survived. Banks are still standing. The stock exchange is still open. The panic hasn't turned into a depression. America has avoided catastrophe. The cost was enormous. Multiple trust companies failed. Thousands of depositors lost money. The stock market had crashed. Unemployment would spike. The economy entered a recession. But it could have been far worse. Without Morgan's intervention, the entire system might have collapsed. If the panic of 1907 sounds like ancient history, think about what happened in 2008. The parallels are striking and disturbing. In 1907, trust companies were shadow banks operating with less regulation than traditional banks. In 2008, investment banks and mortgage companies were shadow banks operating outside traditional banking regulation. Same structure, same vulnerability, same systemic risk. In 1907, the crisis started with a failed speculation scheme in copper. In 2008, it started with failed speculation in housing. Different asset, same dynamic. Excessive leverage, too much borrowed money, bets going wrong, cascading failures. In 1907, J.P. Morgan organized private sector bailouts because there was no Federal Reserve. In 2008, the Federal Reserve and Treasury organized bailouts because the private sector couldn't or wouldn't. The mechanics changed, but the need for a lender of last resort remained. The key lesson from 1907 was that financial systems need a backstop. They need someone with the resources and authority to stop panics. After 1907, Congress created the Federal Reserve specifically to be that backstop. The Fed was designed to do what J.P. Morgan did in 1907, provide liquidity during crises, organize rescues, prevent systemic collapse. But 2008 showed that even with a Federal Reserve, even with modern central banking, financial panics still happen. The Fed had to use extraordinary measures, quantitative easing, zero interest rates, unlimited lending facilities. The government had to inject hundreds of billions into banks through TARP. It took the full power of the modern state to do what J.P. Morgan did alone in 1907. The scale is the big difference. In 1907, Morgan organized tens of millions in bailouts. In 2008, the bailouts were in the trillions. Financial systems have become vastly more complex and interconnected. The risks are bigger. The potential for catastrophe is greater. We also see the same personality dynamics. In 1907, Morgan had to force reluctant bankers to act collectively. In 2008, Hank Paulson and Ben Bernanke had to force reluctant bankers to accept TARP money. Financial institutions don't want to cooperate during crises. They want to protect themselves, hoard resources, and hope someone else fails first. Strong leadership is needed to overcome that instinct. The moral hazard problem is worse now. In 1907, banks knew there was no guaranteed bailout. Morgan might help or might not. In the modern era, banks assume the Fed will always intervene. This encourages risk-taking. Why be cautious when you know the central bank will save you? The Panic of 1907 teaches us three fundamental truths about financial systems. First, financial panics are inherent to modern economies. They happened before central banks existed. They happen even with central banks. They're not aberrations or failures of policy. They're built into the structure of finance. Banks borrow short and lend long. They're inherently fragile. Panic can destroy them regardless of their underlying health. Second, someone needs to be the lender of last resort. In 1907, it was J.P. Morgan acting as a private central bank. Today, it's the Federal Reserve. But the function is the same: provide liquidity during panics, organize rescues, prevent systemic collapse. Without that backstop, the system fails. Third, prevention is better than rescue. The Panic of 1907 happened because the financial system was fragile and unregulated. Trust companies took excessive risks because nobody stopped them. The crisis could have been prevented with better oversight. The same is true today. We keep having crises because we don't regulate effectively until after disasters happen. Here's what's sobering. J.P. Morgan saved the system in 1907 through personal authority and private capital. Today, that would be impossible. The system is too big. The risks are too large. No private individual or institution could do what Morgan did. We're completely dependent on government intervention. That should worry you. It means our financial system is more fragile than it appears. It looks stable because we assume the Fed will always intervene. But what if the next crisis is too big even for the Fed? What if the tools that worked in 2008 don't work next time? The Panic of 1907 led to the creation of the Federal Reserve. The question is, what crisis will we need to experience before we build the next generation of financial safeguards? If this video made you think differently about financial stability and the role of central banks, share it. Because understanding how fragile these systems are is the first step toward making them more resilient. Subscribe for more explorations of financial crises and what they teach us about the systems we depend on. J.P. Morgan saved America almost alone in 1907. Today, we should hope we never again need one person to stand between us and economic catastrophe.